Everyone, Steve Lentz here. I'm the Director of Hearing here at Discover Options. We are the educational arm of OptionVue Systems. Welcome, everyone. And what we're going to talk about today is Bollinger Bands, just a general introduction. This is a fantastic technical analysis tool. Many of you are option traders. Many of you know that volatility is a very important part of options trading. And if you're in volatility, then you're going to love the Bollinger Band concept. So stay tuned here. It's going to get real good. Now what we're going to do is, now let me shift over to another presentation. Here we go. By the way, presented material is for educational purposes only and should not be construed as personalized financial advice. We're going to talk about today is Bollinger Bands, as what it is as a technical analysis tool. I'm going to show you how it's calculated, the general concept behind it, and then also what some typical trading signals would be. Now, later on down the road, maybe when we get together next time in several weeks, well, about 3-4 weeks, what I'd like is then actually show you a trading system based on Bollinger Bands with a few back-tested months there. All right, so that's coming down the road later, but right now, let's just take a look at the general concept of Bollinger Bands, all right? These were developed by John Bollinger, I'm going to say back in the early 80s, late 70s, early 80s, somewhere around then. He's been around a long time. These are bands that are placed above and below a certain moving average. Above and below a moving average of price. They're based upon standard deviation, which would change as volatility increases or decreases. So when volatility goes up, the bands get wider. When volatility goes down, the bands get narrower. How they work, that's kind of the general notion. And then, of course, when price gets too close, and we'll go into signals and all that stuff. Now, in OptionVue and in many charting programs, you'll have a little settings screen for your Bollinger Bands. And this is the example of OptionVue's. And we have a middle band, which is typically, it's not a band really, it's a line. It's simply the 20-day simple moving average. Now some people change that to say exponential, okay, but the default setting is always as a simple moving average, the 20-day moving average, and you can also change the days as well. 20 is a typical, that's the default setting. Bands are also typically set, all right, at 2 standard deviations out. Now look at this. Standard deviations, it's not the second standard deviation in a bell curve, so to speak. We're taking a standard deviation and multiplying it times 2. And I'll give you a spreadsheet in just a little bit that breaks all this down and explains it. So typically the settings are 20 and 2 for your Bollinger Bands. So here's an example. Let's just look at the price of prices, and typically you'll have a moving average kind of cutting through like this. Let me go to the next page. Actually, it goes like this. Look at that. So let me back up and kind of get a visual on that. Okay, it's not that. It's going to go more like. All right. We have about 20 bars here in this particular example. And what you can see then is the moving average is here. The closing price is up here. And we can see that the price deviates from the moving average by a certain distance. Now, as price gets closer and closer to the moving average, okay, the deviation from the average gets lower and lower. Deviation from the mean, so to speak. And when price is hovering right close to the average like it is here, the deviations are very, very small. So in periods where you have deviations from the moving average, the bands will be wide, okay, more volatility from the average, and then when price gets closer to the average, the volatility is smaller. So here's an example of Bollinger Bands. Here's an example. Now let me take a little different color here. You can see that we have the deviation. I'm just going to draw little deviation lines. Here they're quite wide. Bands are pretty wide. Now watch this. When the moving average and price get closer together, and the lines I'm drawing get shorter, top bottom, okay, you'll note then that at that time when the lines I'm drawing get shorter top to bottom, that's when the bands both begin to break inward towards each other. The volatility is getting smaller, the deviations are getting shorter, smaller, the deviations get smaller, the bands get narrower. So what we're talking about here are the deviations from the mean. A standard deviation could also be defined as difference from the mean. Difference from the mean, okay? All right. I'm glad once here we got quite folks listening. That's great. Thank you for joining us. If you've joined since we started, we're talking about Bollinger Bands and just a general introduction. So that's the general concept here. Now let's go to a spreadsheet. I pulled this off the web. I was just looking around at ways to explain all this, and I found this. I thought, boy, this guy's pretty good. He laid out a nice spreadsheet, and you could see his email and all. He did a great job. He has a little blog out there, but he laid this out real nicely, and I'm going to just use his little template to explain this. And I could have drawn it all up on my own Excel, but I thought, no. Let's kind of use this little template here. So here's what we're doing. What's the standard deviation? It's the average difference from the mean, and I'm going to put ... about. It is not the absolute average difference from the mean. Okay, it's roughly that, but that's the general concept. So here's, in other words, here, let me go click back up here. All right. So if I were to take we're looking for the average or the standard deviation, average difference from the mean. Here's the mean, which is the red line here, right? If we were to take each one of these separate incidences, and we're going to have 20 incidences. These will be high. These incidences here will be small. Okay, here, and we took basically the absolute value of each of these variances, these deviations from the mean, and we took an average of those last 20 deviations. We're going to have an absolute average. So here's what we're doing. We're down here on day number 20, which is going to be the 20 there, but because number 1's taken up by heading, we count it. So I-21 here represents day 20 here. This again. But we first had to take the last 20 days of the deviation. So if the current average is 42.1731, and the deviation from that average 20 days ago was 79.74. From that 19 days ago was that 14.74, and we took each day's deviation. You see that? Each day's deviation, and if we were to take the absolute value of these and get the average, we discovered, and I ran this myself. I took a calculator out. I ran this through. The edge is 53.37. On average, this varies from the current average 53.37 points. Example of this index back in 07 where it is. 50.37. That is the average deviation from the mean. Now we could just take that and say, well, that's our standard deviation. But no, world of statistics, they do something else. Something else to help smooth the data, and they take it through an iteration of squaring each one of these, putting the squares and taking the square root of the sum of those squares. By going through this iteration, it helps smooth the data so that when you have one poking like this, here's this number one, see item number in here, item 10, deviation was 104 points. That's kind of poking out there. When you have one, two items in there that are really varying a lot, okay, you want to factor those in and give those a bit greater weight. And so by doing the square root process, it helps, bring things in alignment. It helps reflect the volatility that represents. So here's what you do. You take the square root, square each of these deviations, okay, in I here. You're going to sum all these up. You sum all these up and take the square root of that. And so there it is. If you did that process, and of course you can go on the web and get greater, probably better explanations than what I'm giving you. That's our standard deviation there, 7.86. Now, it varies a little bit from our 5337. That's when you say it's an average, average distance from the mean, the term about, okay? It's not exactly that. It's not exactly average deviation from the mean. All right, the square root and some of the squares process, it gives the volatility aspect to it greater weight. There you have our deviation, and then we're going to take our upper band and lower band, and basically we're going to take the average plus two of these. That's why we're saying 2 times. Okay, lower band, we're going to reduce the average 2 times the deviation here. Okay, so that's it in a nutshell. That's what standard deviation is. So when you actually plot these, and here are 2 deviations, okay, from the moving average. See here then that when you plot these bands, 2 deviations up, 2 standard deviations down, when the deviations get smaller, let me switch colors. Deviations begin to get smaller, you have the bands breaking inward. You have a long history of price being near the average. Look what happens. The bands get really narrow. Bands are very short then. All right. When the deviations from the average get high again like this, look at that one, the bands begin to flare out and widen. End up with then our bands around price, and it's telling you if price is relatively high or relatively low relative to the past. Okay, that's what it's telling you here. So when price over here is way above the 2 standard deviation band, that's telling you that at this level price is relatively very high relative to the recent deviations. It's very high. It closed outside the band. So, let's my next slide. Okay, so how do you trade this stuff? There are a couple different ways. How are you going to view this thing? 2 ways you can do this. One would be reversals, market reversals. Try to pick tops and bottoms. Another way would be to try and play the breakouts, meaning that if price goes up and bumps over a certain deviation, well then, that must mean a trend is in place, right? So what we're going to do is look at the trend being in place and go with that perhaps. But first, let's look at using a 2 standard deviation Bollinger Band and just kind of exploring what a market reversal signal might look like. So I'll show you the Bollinger Bounce page here one moment. Bollinger Bounce. These are typical market reversals. It's a way of using Bollinger Bands to try and determine if the market is going to reverse or not, or at least slow down. And here's how it goes. Let me get my switch the cells over a little bit. Right. Touches or closes beyond the upper or lower line, and then closes inside. So here's what you got to have. You got to have price close or liberally you could just say it touches, but if it closes above the line, above a band, and then closes inside, that's a good indication that maybe price is finished going upward. Now, the case that I'm pointing at, it didn't. It instead kept going. It closed outside, and then 2 or 3 days later, it closed underneath. Then we had choppiness and reversion back to the mean. And that's the idea here, is that when price closes outside the band, it tends to revert back to its mean. See, often when it touches, goes to the mean, touches, goes back to the mean. Now, say here, second time is a charm. Okay. The reason is because you can use Bollinger Bands to really tee off on a methodology devised by Arthur Merrill back in the 1960s, M and W patterns. That means when price goes up and down, making basically a double top. Then there's various definitions of these tops, but here you have, twice. You see this? Close outside the band once, close within. Close outside the second time, close within, but second time's a charm. The idea. Touch the band here, okay? Closed above, okay? Touched, it says closed to above, then that's a signal that it's going to go back up. All right? The second time's the charm. And you can go to John Bollinger's website. He has a number of, he's cataloged some of the patterns by Arthur Merrill. Also, Merrill wrote a book called M&W Patterns. It's out of print. This is kind of the methodology Bollinger loves to use. And if you're doing credit spreads like I am on market option periods, well, this is kind of just a perfect scenario, perfect situation for doing just that. So that's the bounce. That's the market reversals. Now, how could you play this? Let's say you wanted to wait for the second time. You don't take. Sometimes it hits the first time and goes, but if you waited the second time for it to close underneath aggressively, you could sell premium in the calls right outside that pivot point and play the down move, play the market reversal. No way to do it is to go farther out. A standard deviation, out in the calls way above it, challenge the market to yet go up another standard deviation and hit those. It's very unlikely to happen in the course of the next month. Price down, wobble around, very unlikely to yet go up yet another, leg, a standard deviation pace and take that out. So that's trading off of market exhaustion. Okay. Let's look at Bollinger Breakouts. What you do here, instead of using a standard deviation band, it's common to instead use a 1 standard deviation band. And if you have OptionVue, you can certainly use it for this. And what we're doing here is painting 1 standard deviation Bollinger Bands, and the notion is that when price touches or closes beyond the upper or lower line, in this case the green, then that would signal a trend, a breakout of price moving towards a trend. So we're here on the left, touch the upper band, and then if we go on an uptrend, came back down to the mean. Okay, now here the band got real narrow. It hit the lower band, reversed, hit the upper band. That would have been a little whipsaw right there. But here it hit the upper band, boom, off to the races we go on the upside. We hit the lower band, down, went up, it touched the upper band. But if you trade the closes off of that upper band, you'll certainly have fewer signals, but the signals you do get would be better ones. Okay, better ones, and you would stay in the trade longer than that way. You wouldn't whipsaw as much. So I would encourage you, if you're into this volatility thing and you want a little more insight on the price chart relative to volatility, you dial up in OptionVue the 1 standard deviation or 2, depending if you're looking for breakouts or reversals. Brent standard deviation reversals, we set at 2. Trade options either way, trading with the trend or against it on market exhaustion, or trading with the trend, sell premium. How would you do that? How would you trade with trend here? Let's just explore that. When you put a trade on, what should you always have in mind? You want to have in mind, certainly, where it is you're going to get out if market reverses. Okay? Break trend. It closed above the upper bracket there. Where's your pivot? Where's your stop here? You could pivot point underneath and sell premium here, or you could sell premium at the moving average, and comes down and hits the moving average. You're out at that point. Or you could sell even farther away in a 1 standard deviation challenge approach. Challenge the market to come down and hit it over the next month. Unlikely to happen on a breakout from the trend. Now here, it never did close underneath the green. It touched it, did close. So we had our long signal here, sell signal here. It's closed. So if you went with the close, would have gone long over here on the left, short over here on the right. All right, and again, boy, you got to watch it. It might touch that, but it's tough for it to close above that 1 standard deviation there. Okay. All right. Any questions on this stuff? Next time we get together, okay, we're going to go over actual, like what I just suggested. We'll do a little back testing work on some of these definitions and using credit spreads or possibly M and W patterns for the market reversals. All right, point. Just go there with us. We have a great, you guys are asking questions. We have just a reminder, we have a fantastic mentoring program here. Myself and 3 others, staff, and we exclusively on the one-on-one experience. So if you want to become an advanced options trader, we guys that are trading professionally money, they mentor themselves, other accounts, and then they mentor as well for us. And we begin to walk you through the process of becoming a professional option trader yourself. There are all directional strategies I've just showed you, but of course we can also get into when we specialize in non-directional level 3 strategies as well. All right, no questions at this point. Good going, guys. Comments there. Thanks, Vlad. From Roland. Thanks, Joseph. Yeah, we're winding it down. Sorry there. Folks, every Monday, someone we have myself or one of the mentors on our team come and do a presentation for you guys. Make sure you look at your email for next time. On Monday, we have a rotation. We're going to introduce you to a new member of our staff named Paul Forcioni. Looking forward to introducing him to you. He is our futures specialist that will help teach our futures mentoring course, and would love to take you through that as well. All right. On there. Thanks, Jeff. We'll see you next Monday. Take care. Have a great day. Bye-bye.